this one, right?
Yes, sir.
So here, first, as I said, we should calculate the depreciation part. Now here, for calculating the depreciation, I hope you might be aware, we do consider the cost of asset minus residual value divided by life of asset. Once again, I repeat the formula for calculating the depreciation. Whatever the cost of asset, from that cost of asset, we will be deducting the residual value and divided by life of asset. So I believe the cost of asset is 1,10,000, right, Leela? Is that 1,10,000?
So investment is 1,10,000.
Yeah, investment is nothing but cost of asset.
Yes.
Right?
Yes, sir.
1,10,000. And how much value we are expecting after completing the life of asset? 10,000, right?
Yes, sir.
So that is nothing but residual value. So once again, I repeat, for calculating the depreciation, the formula is cost of asset minus residual value divided by the life of the project. So here the life of the project is 5 years. So the annual depreciation which we'll be getting is 20,000. I believe it is clear now.
Yes, sir.
Right. Now in the question, instead of profit, they gave cash. Now how to convert a cash flow into profits? Just we need to deduct the depreciation. So do remember, if cash flow is given, because for calculating the return on capital employed, we need profit, not the cash flow. So in order to get the profit from the cash flow, depreciation amount should be deducted from the cash flow. So our cash flow is just 1 second, please. Sorry for inconvenience. Little occupied with some work. Yeah. So I was mentioning that here cash flow is given. So from cash flow, if you deduct the depreciation, then you will be getting the annual profit. So and I hope you might be aware about the formula for ROC, average annual profit divided by initial capital cost. So because I can recollect that they asked us to calculate by using both initial cost and average capital investment. So average annual profit will be 4,400 and the initial capital cost is 1,10,000. Then it will be 4%. And if you consider the average, or if you calculate the ROC by average capital employed, then the formula for calculating the average capital employed would be initial cost plus the residual value divided by 2. Then it will be 60,000. Any specific query, Leela, which you found difficult to understand in this?
So now I understood, sir. It's
Yeah,
clear.
So just do remember one thing, always excluding ROC. Excluding ROC, for all the remaining investment appraisal techniques, we use cash flows. But only for ROC, we will be requiring profit. So if profit is given, no issue. But if instead of profit, if they give cash flow, then we need to convert the cash flow into profit. So how to convert the cash flow into profit? Cash flow minus depreciation. And how to calculate the depreciation? Cost of asset minus residual value divided by the life of the asset. Okay?
Yes.
Yes.
Thank you, sir.
Yeah. Now I think we can go with the session. 100 participants. Actually,
Recording in progress.
forgot to record this 5-minute section. Yeah. Now this is a very, very, very important chapter. So yesterday I already mentioned. So we'll be taking at least minimum two sessions to complete it. So we should clearly go through the complete content from your study text. So upon completing this, because if you're clear with this chapter means it just thinks that around 20 marks is in your hand. Okay. So I hope, shall I go with the session now? If they gave operational profit, yeah, definitely. If they gave operational cash flow, no need to do that. But if they gave operational profit, we should go with that. Is that clear, Ankita? Yeah, that's what I am saying. In case if they clearly mention that operating profit, don't need to consider the depreciation. Yes. Okay, because in that case, we won't charge depreciation no, for calculating the operating profit. So that is the reason. Okay. Yeah. So shall we go with this new chapter? So as I mentioned earlier, in this modern investment appraisal techniques, we will be giving importance to the time value of money. So we will give importance to time value of money, because in the previous two investment appraisal techniques, that is in ROC and payback period, so time value is not considered. So here first we try to understand what is this time value. So money received today is worth more than the sum received in the future. So because definitely there are certain factors which differentiates the present money and the future money, like the purchasing power, because this particular purchasing power is influenced with the inflation. So this occurs for these three reasons: potential for earning interest, cost of finance, impact of inflation, effect of risk. Now let me focus on the first one: potential for earning interest. Suppose example, today money if you invest, definitely it will be having the capacity to receive or to earn the interest. Suppose if I give an option to you, whether you prefer to take 1 lakh today or 1 lakh after 3 months, definitely you will be going with the present one, because that particular present 1 lakh can be utilized to earn an income. So it means after 3 months, the value of that particular 1 lakh will be more by considering its earning capacity. So that is one reason for the difference between the time value, sorry, the present value and the future value. And the second one is inflation. So inflation means we need to mainly focus on the purchasing power. Say the present purchasing, it means the present value of the money and the future value of the money. So it mainly differs because of the purchasing power or whatever. See, if you can recollect, we discussed an example also relating to that. Suppose if I have $1 lakh today, so I can purchase, suppose if I am going for, let us assume that to purchase a property worth 1 lakh. But if I compromise my present purchasing power, if I sacrifice my present purchasing power, and if I gave the amount to you for a period of 3 months, and after 3 months, not necessary that I will be getting the same property for 1 lakh dollars. So there is a possibility that it might increase. So in this, though, inflation is one reason, and the effect of risk. Now, any guesses what kind of risk is involved here? What does it mean? Effect of risk means what is this risk? Now just see this. The earlier cash flows are due to be received, the more certain they are. Now there is less chance that the event will prevent payment, and earlier cash flows are therefore considered to be more valuable. So it means that risk in the sense I am speaking from the capital retention risk. Capital retention in the sense, suppose if I give that particular 1 lakh for a period of 3 months, then definitely there is a possibility of risk in that, because I don't know whether I will be receiving my amount or not. So that particular risk will also be minimized in case of present value. So the major 2 points which which are to be considered for the difference in the present and the future value is effect of inflation and the potential of the present money to earn the income, nothing but to earn the interest. Of course, the risk is also there, but compared with the first two elements, it is second. So these are the three major reasons for this. Do we have any query on this? Yeah, suppose risk in the sense, let us assume that, see, if I speak about future money, now definitely don't you think future includes uncertainty? Suppose if I say that I will be paying $1 lakh after 3 months, now there is a kind of uncertainty involved in this. Don't know whether I will be paying it or not, because there are several factors which are to be considered. Suppose if I have the same financial position after 3 months, then only I will be in a position to pay that particular promised amount to you. But if my same financial position is not there, suppose if I what is this turned under the financial clutches, then definitely I won't be in a position to pay my promised amount. So definitely a kind of risk is involved because of uncertainty. So that risk will be minimized if it is a present value. So that's why if I ask, if you prefer to go with the present value, nothing but present 1 lakh or future 1 lakh, we definitely will be going with the present 1 lakh. Because future, if I speak about future, a kind of uncertainty is involved in that. So that is the risk which we are speaking about this. I hope it is clear now. Yeah. Now the power of compounding, generally, I hope most of you might be aware about Warren Buffett. Yes, anyone? Are you aware about Warren Buffett? Yes. Can anyone give a little information about him? What exactly? Why he is very famous?
He is an investor.
A very valid point, investor. Okay, but most of the all we see there are number of investors, right? But why we specifically focus on this? Okay, very interesting point I got from James. He is an US billionaire who became rich through stock market. Absolutely right. Now here generally he is a businessman, but he is not in the traditional business, because what I'm trying to say here is he just picked the stocks, he just picked the companies which is having a greater potential to earn the income in future. So he is a what is this a stock market specialist, or we can also say that mother of what is this investments, right? So now generally you don't believe most of the world stock market, most of the investors generally they follow. Yes, I request the participants to please future speakers. Most of the investors throughout the world just follow the Warren Buffett. So they will mainly they are mainly interested to purchase the stocks which are purchased by the Warren Buffett. Yes, yes, exactly, Farhan, correct. So because Warren Buffett says that compounding is the eighth wonder. Now let me show a small example of the power of compounding. Let me open my Excel sheet. Just 1 second. Warren Buffett says that compounding is the eighth wonder. Now let me show why it is considered as the eighth wonder. Suppose let us assume that maybe in another 2 years. I hope most of you are in first year of your graduation, right? First year only, na?
Second year, sir.
So sorry, second year. So maybe in after 2 years, then your career might start. So if you want to go for a career after your graduation, maybe after 2 years your career might start. Now let us assume that you started saving, or it means started saving 1,000 every month, and you are planning to retire maybe after 30 years. So if you save 1,000 for a period of 30 years, now we'll see how this compounding will affect this. Now let me show this. And we are considering only the risk-free rate of return. It means the minimum return which generally banks gives. I'm speaking about maybe 6% per annum. I consider only 6% per annum. And I mentioned about 30 years, you are planning to invest every month 1,000 for a period of 30. So 30 into 12, so how much it will be? Around 360, right? And here we are contributing how much? 1,000. So just see this amount. I hope you might have saw this. Sorry, this is 0.5%. Yeah. So approximately your final value. So I hope you can see this approximately 10 lakhs 4,550. This is the power of compounding. Now generally 1,000 it means 12,000 per annum, and if it is for 30 years, so 12,000 into 13, how much it will be? 3,60,000. But with the effect of this compounding, your future value of the amount will be around 10 lakhs 4,515. So that's why Warren Buffett sees that compounding is considered as the eighth wonder. So approximately your money is around 3 times on an average. It is approximately 3 times. Now this compounding concept we will be applying in our financial management also, because as a finance manager you need to understand how this particular compounding will affect your investment, right? And because the compounding is a major factor which differentiates the present value and the future value. So there is a small example illustration given on that. So here you can see an investment of $100 is to be made today, and what is the value of investment after 2 years, and if you are expecting an interest of 10% per annum. So this is very simple calculation. I don't think I need to give an explanation on this. So the value of 100 after 1 year, it would be 110. And if you reinvest the same 110 at the beginning of the second year, then your value of the money will be 121. In simple terms, if you invest $100 today, the value of this $100 after 2 years will be 121. Right? Because compounding is nothing but interest on interest. So instead of withdrawing the interest, if you consider your interest as your reinvestment, then you will be yielding the benefit of this particular compounding effect. And I don't think I should give more discussion. We should have a more discussion on this. I hope it is clear. Do you have any query on this compounding effect? Because these are very, very simple. So if you are clear means I will be skipping it. Any question on compounding? Yes. Hello. Hello. Am I audible?
Yes, sir.
Now the discounting in order to convert a future value into the present value. So I am assuming that you don't have any queries on compounding because I believe you might have learned in your phase 2 levels also about this compounding. Okay. So the discounting here is because as per the discounting investment appraisal techniques, as I already mentioned, we need to convert the future value into you want me to explain the compounding? Compounding is nothing but just converting a present value into the future. It means if you invest a specific amount today, what is its value after a specific period? So the major word, the compounding in the sense interest on the interest. I hope you might be aware we do have two concepts, simple interest and the compound interest. Simple interest is nothing but the interest which is chargeable on the principal amount is considered as simple interest. But compound interest means the interest which is charged on the principal plus interest. So say for your better understanding, here they give a small illustration. If you invest $100 today, so what is the value of that particular $100 after 2 years if you are assuming 10% interest? Normally, if it would have been a simple interest, first year we would have got 10 as interest, and the second year we would have got 10 as interest. It means as on the basis of simple interest, the value of your 100 after 2 years would be only 120. But if it is a compound interest, so first year you can see the value of your investment after 1 year is 110. If you invest 100, it will be 110 after 1 year. Now, if you reinvest this particular 110 by the same expected 10%, then its value will be 121. It means with simple interest, the expected value of the investment is only 120. But with a compound interest concept, because we calculated the interest on principal plus interest, then your value will be 121. So compound is nothing but charging the interest on both principal plus interest. Okay. And don't expect don't expect these compound interest numerics in your MCQs. Okay. Now, just you can see this. There is a query regarding the compound. So you have $5,000 to invest now for 6 years at an interest of 5% per annum. So here, what is the value of investment after 6 years? You can easily use your Excel sheet. So they are asking us to calculate the future value. So first the rate. So what is the rate of interest? 5%, 5% per annum, and you invested 5,000 and you are waiting, you are holding it for 6 years. So you want to know what is its value after 6 years. So the value of your 5,000 after 6 years would be 6,700.48. So this is the calculation of the future value by using the compounding concept. Any question on this? Answer to that? Yes. I hope it is clear now. I think Kavya, I hope I addressed your query. Yes. Now the discounting. So as I mentioned, now the modern investment appraisal techniques mainly focus on the discounting concept. Now we try to understand what is this discounting. Now in a potential investment project, cash flows will arise at many different points. If you can recollect yesterday case also, in 2020 we invested an amount in a project and the project starts yielding nothing but the project returns was started after 1 year. So here, the modern investment appraisals mainly focus that you need to convert the future value into present value. The reason why you need to convert, because the expected cash inflows from the project spread across the different periods. We are not receiving the cash flows within the same year. If I start a project in 2020, I won't be receiving the returns from the project in 2020 itself. So it will be maybe for 5 years or 6 years or 10 years. So always it is appropriate to convert the expected future value into present value. So here you can see in a potential investment project, so cash flow will arise at many different points in time, and to make a useful comparison of the different flows, because they strongly clearly says that it is inappropriate to consider the viability of a project by considering the cash flows at two different levels. You need to convert the future value into present value. All these cash flows ought to be converted at a common time, nothing but a common point in time. So generally we prefer for present day, because we know that the present money or the present cash is more important than the future cash. Because in order to eliminate the uncertainties in the future, we need to convert all the future expected cash. Suppose if I say that I invested in a project with $1 lakh, and the project will give a return, or the project will give a cash flow of 30,000 after 1 year. In 2020, I invested 1 lakh, but the first cash inflow from the project starts in 2021. Now, in this case, what I need to do, what is the value of that particular 30,000 which I am receiving after 1 year in the present terms? That is technically known as present value. So future expected 30,000 should be converted into present monetary terms. That is known as present value of money. So here you can see 0. So always do remember 0 is nothing but that point at which we started our investment. So if I started investment, if I invested on January 2021, then that is considered a 0 point. And first year, it means when my project gives the first cash flow. Suppose if I am expecting my first cash flows on January 2022, that will be my first year. And the next year, January 2023. So this is, so it means the future value. Suppose if I am expecting 50,000 in the January 2023, what is its present value? So shall we discuss a small illustration on this so that you can clearly understand the discounting concept? Shall we go further? Yes. I am expecting you to respond. I don't know whether I'm audible to you or not.
Yes, sir.
Let us assume that we invested in a project 1 lakh, and the life of the project 5 years, and expected return, or we can also consider that the risk-free rate of return or the discount factor return, anything, or effective rate of interest. Let's just see this. Now, I invested in a project $1 lakh, so the total investment is 1 lakh, and the life of the project is 5 years, and effective rate of interest is 8%, and the project will be giving the returns That is, after 1 year, the project is going to give a cash inflow. Let us assume that 20,000 for the first year, second year 35,000, third year 50,000, fourth year 65, and the last year 80,000. Now just carefully focus on this. So I invested 1 lakh, and this project is going to give me the returns for 5 years, and the effective rate of interest 8%. Now you can assume that effective rate of interest is nothing but we can consider the several factors like inflation and the cost of capital for procuring this 1 lakh. And this project is going to give a return of 20,000 in the first year, second year 35,000, third year 50,000, and fourth year 65, and the fifth year 80,000. Now these are future values because we are not receiving all these cash flows immediately. If I invested in 2020, I'm not receiving these cash flows in 2020. It is spread for a period of 5 years. After 1 year 20, after 2 years 35, after 3 years 50, after 4 years 65, and after 5 years 80. So there is a time difference in the cash inflows and the cash outflows. So the discounted technique, what it says is, whatever the future cash outflows are there, whatever future cash flows which we are expecting, that we need to convert into present value. So how to convert it? Now let me show this. So first, cash flows. Now carefully observe the discount calculation, discount factor, because in order to convert a future cash flow into present value, we need a discount factor. So discount factor I am considering at the rate of 8%. Now try to observe the formula here. 1 divided by 1 plus rate, that is 8%. This is the discount factor for the first year. Normally in your financial management paper, they will be providing these discount factors. If they don't provide also, you need to know how to calculate. So it means, technically speaking, what is this 0.92? See, the value of 1 rupee, suppose let us assume that if I am going to receive 1 rupee on 31st December 2021. So the value of that particular 1 rupee on 1st January 2021 will be 0.92 pice. Once again, I repeat, if I am expecting to receive 1 rupee on 31st December 2020, the value of that 1 rupee on January 2021 will be 0.925 by considering the discount factor at the rate of 8%. I hope you understood the meaning of this 0.92. It means 0.92 on January 2021 is equal to 1 rupee on 31st December 2020. Is that clear? Yes. Yes, I didn't understood, Aksha. Did you understood the concept or didn't understood? I didn't understand. Let me know.
Can you explain again?
Yeah. I will be explaining it. See, let us assume that I am going to receive $1 on 31st December 2021. Now this is the future value. Now I want to know the present value. So what will be the value of $1 in present terms? So the value of $1 will be 0.925. It means 0.925 on January 2021 is equal to $1 on 31st December 2021. So this $1 on 31st December 2021 is known as future value, and this 0.925 is known as present value. So in our discounting techniques, what we will be doing is we convert a future value into present value, because we cannot make an investment decision by considering the cash flows of two different time intervals. So we should convert the expected future amount into present value. So in this case also, I assume 8% as my discount factor, and by considering the 8%, I converted the future value into present. So technically, the answer here you should understand that the value of $1 in present terms is 0.925. No, did you understood this? Yeah. Now one more thing is, yes, if you are receiving $1 after 1 year, then we got its present value will be 0.925. But what if you are receiving $1 after 2 years? What is the value of that particular $1 which you are receiving after 2 years in present terms? So we should calculate for the second year also here. So just see the formula. 1 divided by 1 plus 8%. And we are expecting to receive after 2 years. So its value will be 0.57. So it means that on 31st December 2022, if you are expecting to receive $1 on 31st December 2022, the value of $1 in present terms will be 0.857. Now, before I go with the third step, I want everyone please focus on the discount factors for the year 1 and the year 2. Is that clear? Any query on these two calculations? Yeah. Yes, Leela and Vardhini, I hope the concepts are clear for you. Yes. Now the next one, third year. Now, you want me to show the calculation? Okay, let me show the formula. So just highlighted the formula. I hope you can see that. Now, how to calculate for the third year? So first 2 years I calculated the present value. Now, how I can go with the third year? One divided by 1 plus 8%. Now we are calculating for the third year. So go to the power of 3. So it is 0.79. So the future value of the third year. So the value of $1 after 3 years is equal to 0.79 in the present terms. So similarly, we will be calculating for the fourth year. And the fifth year. So I hope these discount factors are clear. Now we can calculate the present value. So it means that I'm here the company or the project is giving a cash flow of 20,000 after 1 year. So what is the value of that particular 20,000 in the present terms? So 20,000 into the discount factor. It is 18,580. So same for the second year. 35,000 after 2 years. So what is the value in the present term? 35,000 into 0.85. So it is 30,006. And for the third year, 50,000 into 0.79. It is 39,691. And for the fourth year, 65,000 into 0.73. So it is 47,076. And the last year, 80,000 into 0.680. So it is 54,446. Now if you calculate the total of these, this is known as present value. Present value of cash flows. Now let me explain this. If you invest an amount of $1 lakh, the project will be giving $1,90,440. So in this case, we converted all the future cash inflows into present value, and we got the present value of 1,90,440. So if you are investing 1 lakh today, then the value of its return, value of its cash flows in today's term is 1,90,440. Now, what do you think? Is it viable to go with the project? Is this can the company or the finance manager can accept the project here? Because we are investing only 1 lakh, but the present terms of its return is 1,90,440. So it means the cash inflow from the project is more than the cash outflow, because the cash inflow from the project is 1,90,440 and the cash outflow is only 1 lakh. Now, what do you think? Is it should the finance manager accept the project or the reject the project? Yes, we can go with the project. So technically, this is known as net present value. So the net present value of the project will be how much? It means what is the extra returns which we are getting? That is 1,90,440 minus we invested 1 lakh. So it means if you start the project, we are having a net value of 90,440. So always in this case we can go with the cost. So in this case we converted the future cash flows into present value, and we are considering it as the present value of cash flow, and we are comparing this present value of cash flow with our initial investment. If this present value of cash flow is more than your initial investment, then always it is preferred to go with the project. Suppose if you are having 3 or 4 alternatives, 3 alternative projects are there. Now among these 3 alternatives, you need to select one. Now how we can select the one? We will be calculating NPV for all the 3 projects. Now in this 3, whichever is higher, that is acceptable. So before going with the next illustration, let me know if you have any query on this. Any question? Shall I give a small illustration? Will you try? Shall I give? Yeah. Now let us assume that our investment is $1,50,000. Life of the project 5 years. Effective rate of interest 7%. Now cash flows. That is in that 35,000. Yes. So these are the expected cash flow from the project for the first year, for the 5 years, and effective rate of interest is 7%. Our initial investment is 1,50,000. Life of project is 5 years. So just I will be giving 5 minutes time. So please once try. What will be the net present value of the project? So I'm expecting that participants are working on this. So here I got an answer from Naina, 2,57,792. For the time being, just I will be putting in my Excel sheet. We'll see whether it is correct or not. 2,57,922. And one more advice here I want to give. Always try to do these kind of things in your Excel sheet only, because you need to practice working on spreadsheets. Because especially for your F7 paper, financial reporting and financial management, the 20 marks consecutive based question, you need to do your calculations in spreadsheet only. So if any specific assignment or homework is given, so try to practice this in the spreadsheets. So I got the answer from one participant. So what about others? You can take your time, don't rush, but try to understand the concept when you are doing this. So yeah, 2 decimals is perfectly fine, no issue. The present value is 2,57,921. 1,07,921. So Fatima also got 2 lakh. Okay. I can see that some participants got an NPV of 1 lakh. Now here just I want to know, is it NPV 2,57,922 or you are saying the present value of the cash? Now just I want, I think 2,57,000 is the present value. Okay. Yes. Some participants gave directly the net present value. 1,07,922. Yeah. So I appreciate the participants for your work. Very good. Now let me put it in Excel sheet. So the discount factor at the rate of, yeah, net present value is 1,07,980. Very good. Very good. We'll see that. 7%. Now present values will be 2,57,921. So and our NPV 1,07,921. Very good. So I hope the concept is clear. Now this is nothing but the concept of discounting, and you can't even think about an FM paper without a question on NPV. Definitely NPV will be tested in your 20 marks case, and you might expect a scenario based question also from NPV. So the basic concept relating to discount factor, I hope it is clear. Now, so to appraise the overall impact of a project using the DCF, means discounted cash flow technique, involves discounting all the relevant cash flows associated with the project back to their previous. So here, if we treat outflows of the project as negative and inflows as positive, the NPV of the project is sum of the present values of all future that arise of the result of doing the project. So here NPV represents the surplus funds. It means the difference between the present value of cash flows minus the investment. Now always, as I mentioned, if the NPV is positive, we can assume that the project is financially viable. And if the NPV is zero, this is very important point. If the net present value is zero, when the net present value will be zero, if your present value of cash flows is equal to your investment, then in that case, your NPV will be zero. So the project breaks even, it means there will not be no surplus or no deficit. It means the project is having the capacity only to recover their initial investment. That's it. We're not expecting any surplus from that. And if the NPV is negative, the project is not financially viable. So upfront we can reject all those projects. Suppose let me give an example. if a company want to start a project with an amount of 1 lakh, but we are having 5 alternatives. Now, among these 5, we need to choose the best alternative. So in that case, we can apply this net present value. We can calculate the NPV for all the 5 projects, and among these 5, whichever project is having high NPV, that can be selected. And as I mentioned, if the NPV of the project is negative, we assume that it is not viable. If the company has 2 or more mutually exclusive projects under consideration, it should choose one of the highest NPV. As I mentioned, the project which gives high NPV, that should be selected. Now, very interesting point. The net present value gives the impact of the project on shareholders. Now, let me explain in detail. Now, generally, it is assumed that the project which is having high NPV, we will assume that it will increase the wealth of the shareholder. Even what is this? The senior finance manager also, if you want to fulfill the primary objective, that is wealth maximization, he always prefer to select those projects which is having high net present value. Okay. So before we go to the next step, I want everyone to please look into this highlighted part and let me know if you have any questions. Any question? Shall I continue my discussion? Okay. Second point and the third point want me to explain. Let me explain that. Now the second point sees that if the present value of the cash inflows, see, let me show this. This 2,57,921 is considered as present value of cash inflows. Now, if this is equal to our initial investment, 1,50,000, then we say it as a break-even point. Break-even point means the project is having the capacity only to return back your initial investment. That's it. It is not generating any extra, nothing but surplus returns to the entity. That is known as break-even point. It means the present value of the cash inflows is equal to their initial investments. Okay. Now the next one is outflows as negative. Yeah. Now here outflows as negative and inflows as positive means we are assuming this 2,57,921 as cash inflows. Now cash inflows is nothing but, don't you think, if a project is receiving or if the project is generating cash inflows, it is a positive aspect for the company. So we'll assume it as a positive element. And the initial investment, that if you are whatever amount which you are investing, now in that case there is a cash outflow. So cash outflow we assume it as negative, and cash inflow we consider it as inflow. So cash inflow, nothing but whatever the present value of cash inflow is there, we'll assume it as a positive. And whatever we are incurring, and whatever we are spending on the project, that we assume it as negative. And fifth point, let me see what is the fifth point. If the company has 2 or more mutually exclusive projects, suppose 2 projects are there. Now let us assume that 2 projects are having what is this positive NPV. but we can go with only one project because the company have only 1 lakh to start the project. But two alternative projects are there. Both the projects are having positive NPV and it is mutually exclusive projects. It means we cannot start both the projects. If you want to go with alternative one, then you need to leave the alternative two. These are known as mutually exclusive. In that case, whichever is having high positive, high NPV, that project we will be selecting it. One, okay. So I hope you are asking about the last one, right? Now NPV gives the impact of the project on shareholders' wealth. It means that the finance manager, whenever he is selecting the project, so the main point which he need to focus is whether the project is having the capacity to maximize the wealth of shareholders or not, or technically whether the project can increase the share price in the market or not. Now generally we assume that the project which gives higher NPV will maximize the wealth in the stock market. So finance manager will assume that if a project can generate a higher net present value, it can increase the wealth of the shareholders. So that is about the last point. So NPV is considered as a measure or considered as a performance indicator for assessing the wealth maximization capacity of the project. Any other query? So I hope all the points are clear. So here there is a explanation given for this. Suppose in an investment problem, we calculate the NPV of certain cash flows at 12% to be 97 and at 10% to be 0 and at 8% the NPV of the same cash flows is 108. And another way of expressing it, see, just try to understand this. Now we calculated the NPV of certain cash flows. Suppose if you assume our discount factor at 12%, we got minus 97. So now what minus 97 means? If you consider the discount factor at the rate of 12%, we got NPV as minus 97. What does it mean? Yes. Minus 97 is nothing but it is a negative NPV. So if it is a negative NPV means we cannot go with that. It is not financially viable, right? But if you consider 10%, if you consider our discount factor at the rate of 10%, then we got it as 0. It means a break-even stage. And if you consider at 8%, the NPV is plus 108. Now, technically, how we can understand is if the funds were borrowed at 12% of the 12%, the investor would get a 97 out of pocket. That is nothing but it means what I'm trying to say. Whenever you want to select a project, whenever you are selecting a project, so the main point which we need to consider is at what rate you borrowed the fund. See, here definitely the viability of the project mainly deals with the cost of capital which we incurred to borrow the money. Now let me give you a small example. I borrowed $1 lakh at the rate of 30% per annum. At the rate of 30% per annum, and I opened a supermarket. And let us assume that the supermarket gave me a return of 24%. Now here the question is whether it is viable to go with the supermarket business. No, because here there is a negative NPV. It means what I am trying to say, why we rejected the supermarket business here, because you borrowed the funds at an excessive capital, excessive interest of 30%. So it means in order to make the project as viable, you always prefer to borrow the funds at a least rate of interest. It means that you need to always focus on minimizing your cost of capital. So if the funds were borrowed at 12%, the investor would be having a position of 97 out of pocket, nothing but a negative effect. So investment earns a yield below the cost of capital. And if the same funds are borrowed at 10%, then you will be at a break-even stage. No profit, no loss. But if you are succeeded in borrowing the funds at 8%, then you will be getting in pocket, nothing but you will be getting a surplus, that is positive NPV. So a positive NPV is an indication of the surplus funds available to the investor now as a result of accepting the project. So very, very important point. So if the fund positive NPV is the indication of the surplus funds available to the investor. So it means if a company is always going with a project with their surplus funds, then the project can be accepted. Of course, the project business model is very rich, but if the funds are procured with a high cost of capital, then definitely we might declare the project as not viable. I hope you understood the concept. So here the major element which we should consider is at what rate you are borrowing the funds. Suppose if you are utilizing from your surplus funds, then definitely maximum chances will be there for the company to go for what is this new projects. Now here surplus funds are nothing but retained earnings. Now just try to link the concept now. If a company prefers to issue more percent of dividend to the shareholders, then definitely they will be having less funds, less surplus funds. Now, if they have less funds, they need to depend upon external sources. If they depend upon external sources, there is a chance of incurring high cost of capital. If high cost of capital they are incurring, most of the projects might be not viable. I believe you might have understood the logic here. Any query on this? Or just go through this NPV and let me know if you have any questions. So I hope it is clear. Now we'll focus on certain assumptions which we need to consider for discounting. Now, assumptions here, unless the examiner tells you otherwise, the following assumptions are made about the cash flows. So all cash flows occur at the start or the end of the year. Now, generally we assume that the cash flow starts at the end of the year, and initial investment will be at T0. T0 is nothing but the date on which the investments are done, and other cash flow starts at the year after that. Nothing but if you are investing on T0, it means if you are investing on 1st January 2021. Now, our first inflow will be expected on 1st January 2022. That is known as T1. If you receive cash inflow after 1 year, that is T1, and the initial investment which you made, that is known as T0. So these are the common assumptions which we are considering. And in addition to that, you should never include interest payments as cash flows within an NPV calculation, because most of the students are confused here. You should never include the interest payments as cash flows within an NPV calculation, as these are already taken account by the cost of capital, because we are converting a future value into present value by considering a discount factor. So we assume this particular discount factor as the interest payment. No need to additionally calculate the interest payment for calculating the NPV. Now NPV is an important technique, so which you will develop further if you choose to study the advanced. Now anyway, the concept of NPV is there in your advanced financial management, but for our FM perspective, you need to know the calculation of NPV when the cash flows are even and when the cash flows are uneven, and the effect of inflation on the NPV, effect of working capital on the NPV. Now these are certain tested elements relating to NPV. So I hope the assumptions are clear. Now there is one question relating to this. The cash flows for a project have been estimated as follows. So what is this 25,000 means? Can anyone? What does it mean? Yes, it is a investment, and you can find the cash flows of the project. That is 1 year it is 6,000, 10,000, 8,000, and 7,000. And they gave cost of capital is 6%, and convert these cash flows to an NPV. And they are also asking us to calculate the net present value, whether it is viable or not. So just once try it. What is the NPV for this? Just give me 1 second. Yes, sir. Meantime, please try this one. So I hope you are trying this. What is the NPV for this? One eight double two. Very good, Naina. See, I am expecting these test your understandings. I hope everyone knows the calculation of this. So this test your understanding, please consider it as your homework. Okay. So shall I skip this test your understanding 4? I think you know this, right? How to calculate. So that's why just I'm skipping this. Can I do that? Yeah. Now for section A MCQs, the advantages and disadvantages of NPV is very important. So let me focus on the advantages and disadvantages part. So here NPV method of investment appraisal. Now generally we assume that among all the investment appraisal techniques, this NPV is considered as a superior method. Suppose if you consider the payback period or return on capital employed, so we do consider this as a superior method. So there are certain advantages. So the first important advantage is it considers the time value of money. In case of payback and ROC, time value was not considered. But in this case, the time value of the money is considered, and it is an absolute measure of return. Now, why we are saying it as absolute measure of return? Because we clearly know what is our excess cash flow from the project. It is clearly expressed in the terms. Suppose in this case, if you go with this particular project, we can expect an excess cash surplus, nothing but we can expect a cash surplus of 1,07,921. So it is clearly expressed in absolute terms. So this is also one advantage, because in case of ROC, we generally say that the expected return from the project is 15% or 20%. It is mentioned only in the percentages, not in the absolute terms. But in case of in case of NPV, we will be expressing the return in absolute terms, and it is based on cash flows, not the profits. Because if you would have considered the profits, always there is a possibility of what is this to add certain nothing but possibility of garnishing was there. But in this case, we consider only the cash flows. We eliminate the non-cash items. And one more thing, we consider the whole life of the project. Because in case of payback, only payback period is considered. We completely ignore the post-payback period. But in this case, the total life of the project is considered. Then, as I already mentioned, it will lead to the maximization of shareholders. Because if the project is having high NPV, then it might increase the wealth of the shareholders. So these are certain advantages, and disadvantages. Now let me explain the disadvantages in detail. These are very, very important. Drawbacks. It is difficult to explain to the managers to understand the meaning of the NPV calculated requires an understanding of discount. So the method is not as intuitive as techniques such as favor. Suppose let us assume that I need to communicate this information to my managers. Suppose if I communicate, if I say that if you go with the project 1, you are having a positive NPV, and if you go with the project 2, you are having a negative NPV. Then first my manager will be asking, what is this NPV? And how you got this NPV? And why you consider 8% or 9% or 10% for discounting? Suppose if I say that 8%, why you consider the 8%? Why not 9%? Now, generally do remember the reason for considering the discount factor is it depends upon the credit worthiness of the company. If a company can borrow the funds at 8%, then we can consider 8% as a discount factor. So the cost of capital of the company is considered as a main base, but it is very difficult to explain the same thing to the managers. So there might be a possibility that he may not be convinced with that. And it requires knowledge of the cost of capital. As we'll see in anyway, cost of capital is there in the next chapter, where we'll be discussing the procedure for calculating the cost of capital. And it involves gathering data and making a number of calculations based on the data and some estimates. Because as I mentioned, the discount factor is calculated on the basis of cost of capital. But in order to calculate the cost of capital, there are different concepts which are to be considered. So it is very difficult for a finance manager to communicate all these things to the decision maker, and it is relatively complex. So for the reasons explained above, NPV may be rejected in favor of simpler technique, because if you consider the complexity in calculation, see, it is very difficult to calculate NPV compared with the previous two methods like payback and ROC. So these are certain drawbacks. So Any query on the drawback? Let me know if you have any question on this. Very good question, Jero. Yeah, in spite of all these drawbacks, NPV is considered as a superior method. So in practice also, we will be using the net present value for making the investment decisions. In this NPV also, there are certain elements which are to be considered. Anyway, we'll be discussing this. But the answer for your question is yes, NPV is the superior method of all these investment appraisal techniques. Okay. Is that clear? Now here you can see, although you will be able to perform almost any NPV calculation using the above information, now there are number of time-saving techniques that can help you in the exam. This is very important. Present value tables. So these are called the discount factors. In exam, you will be provided, as I mentioned, this present value table will be provided in your exam. So you can refer the present value table and you can find the discount factor. Suppose, let me show a small thing. I hope you can see the annuity table, right? Can you see this? Yes. Suppose these kind of table will be provided in your exam. Suppose if the cost of capital is given at 8%, if the cost of capital is given at 8%, so the value for discount factor for the first year is 0.926, second year 0.857, third year 0.794, fourth year 0.735, and 0.687. Is that clear? No need to calculate. If the generally in exam they will be providing the discount table. So directly you can find the respective uh, interest rate or the discount rate, and accordingly you can get the discount values. For the first year it is 0.926. Suppose if the rate of discount is 10%, then we can consider this. And one more point, now in the previous NPV calculations, the cash flows are uneven because we didn't have same cash flows for all the years. So that's why we applied that particular formula. Suppose if the cash flows are same, if you are expecting that for the remaining, whatever the life of the project is there, if you are expecting that the cash flow is 50,000 for every year, if the cash flow is 50,000 for all the 5 years, there is no change in the cash flows. That is known as uniform cash flows or even cash flows. Now in that case, directly you can go to the annuity table. Now here you can see the annuity table. Suppose if your discount factor is 8% and if your life of the project is 5 years. So what is the annuity value for 8%? 3.993. So if you are assuming 50,000 cash flows, so 50,000 into 3.993. So your present value of cash flow will be 1,99,060. Now, no need to do all these calculations. If these cash flows are same every year, if your cash flows is 50,000 only, directly you can take that 50,000, just go through your annuity, go through the annuity table. And if the life of the project is 5 years and the discount factor is 8%, then you can take this value and you can multiply it with your cash flow. I hope you understood it. So this will save your time. No need to follow these steps if the cash flow is uniform. Did you understood that? Yes. I hope I'm audible. Yeah, let me know if you have any question on this. Hello. '66 page number. Thank you very much. Uh, is it any query on this? Okay. Yeah. So this can be. So here there is a question. What amount should be invested now to reach 10,000 in 4 years? So this is nothing but they are calculating. They are asking us to calculate the present value. So directly by using the discount table, we can do that. Okay. Now just see this one. A payment of rupees $1,000 is to be made every year for 3 years. So the first payment occurring in 1 year's time. So the interest rate is 10%. So what is the present value of the annuity? So directly by referring it to the annuity table, we can do this. Now in this case, if you observe, there is no change in the cash flow. Every year the cash flow is same. So you can directly follow this method. Instead of that, as I mentioned, directly you can go through the annuity table because the cash flows are same, and at 10% you can find the annuity value. Suppose at 10% in the annuity table, the discount, the value annuity value is 2.486. So 1000 into 2.486, you will be getting 2486. It means instead of doing this process, if the cash flow is same, uniform, so directly you can refer the annuity table and you can calculate. Okay, I hope you understood it. Any query? Hello. Yes, before going with the next one, let me know if you have any question on NPV calculation. I'm expecting you to respond. Yes. Now, next concept in here is perpetuity. Suppose if you are unable to calculate the uh, life of the asset, because in most of the cases, discounting factor. I didn't get your query, James. Can you please little clear on your question? So I believe that you are asking how to calculate the discount factor, right? Or how to see it in the table. Okay, calculation part. Okay. Suppose if we assume 7% as our discount factor, so the formula for calculating the discount factor for the first year, that is 1 divided, actually the formula is 1 divided by 1 plus r whole to the power of n. So first year 1 divided by 1 plus r. R is nothing but the rate of discount which we are considering, that is 7%. So this is for first year, and the second year same 1 divided by 1 plus r whole to the power of 2, because we are calculating the discount factor for the second. Just you need to remember the formula 1 divided by 1 plus r. But in exam, as I mentioned, you can save your time by referring the discount factor tables or the annuity tables. Okay. Yes, this perpetuity and the next concept of NPV we'll be discussing in the next session, because I can see that most of the students are already exhausted. So in any query on today's discussion, if you have any question, let me know. And just go through some examination exam kit queries from your chapter 2. I can see that some students are already done this, so please others also please do that. Why we are calculating the discount factor here? The reason for calculating here is to convert a future value into present value, because the main objective of this discounted investment appraisal techniques is we will consider the time value of money. Because if I want to make an investment decision, suppose I am investing $10,000 on 1st January 2021 in a business, and the business is giving the return after 1 year. It means after 1 year, let us assume that it is giving a cash flow of $1,000, and after 2 years it is giving $2,000, and after 3 years it is giving $5,000. Now, if I want to make the investment decision, it will be very difficult for me to consider the cash flows which are in different timing, because I invested today, but my expected returns are in future. So that's why whatever the future expected cash inflows are there, I need to convert all those future cash inflows into present value. Now, how I can convert into present value? By using the discount factor. Suppose in the discount factor here you can see 0.9345 at the rate of 7%. The future value of 1 rupee is equal to 0.93 in present terms. So like this, I will be considering calculating the discount factor for all the 5 years, and then we will be getting the present value of the future cash flows. So here you can see I am receiving 35,000 after 1 year, 45,000 after 2 years, 70,000 after 3 years, 80,000 after 4 years, and 95,000 after 5 years. Now I want to know what is the value of all these future cash flows in present terms. So its present value is 2,59,000. 9:30. I believe I addressed your query, James. Yeah. Notes under annuity table, page 67. Okay, let me see the 67. See, here there might be a small difference due to the rounding up. Here you see the table should not be used as a substitute for knowing how to use the formula. Remember, the tables only cover a small range of discount rates and the time periods, and you may be required to calculate a discount factor, annuity factor for variables outside the range. It means that in the table you can observe that only some percentages are given. Now let me show this. Yeah. So here we can find only 1%, 2%, 3%, and up to 10%. Sorry, up to 20% they give. Suppose if your discount factor is 22%, then the table may not help you. In that case, you need to depend upon the formula only, right? So that was the thing that note speaks about. Okay. Okay. So if you don't have any queries, we can end the session. And once again, I repeat, please go through some exam kit queries from your chapter 2. And if you have any queries on this, let me know. So tomorrow or next session, I think we are having an session on 9th, right? So on 9th, we'll be having a discussion on, and we'll continue with the remaining concepts of net present value. Especially, we try to understand the calculation of NPV when there is perpetuity. Perpetuity means if you are unable to, if the project don't have any specified life. So how to calculate the NPV? So that we'll be discussing in the next session. Page number 113. Let me go to that. Page number 113 of exam kit or study text?
So study text.
Okay. Yes, what is your query here?
So in calculate the payback period for the 113.
Yeah, 130. Okay. Yeah.
So now page number 113, sir. PDF page 113.
Okay. Okay. Okay.
The test you understand 12. Okay, so here in the calculate the payback period of G, we are not getting the same answer as the answer key.
Let me see this. Okay, in this case, initial investment represents the purchase of a plant and equipment whose realizable value will be 20% of the initial cost. So received in addition to the above flow. Right. So I hope you got same answer for E and F.
Yes, sir. E and F we got same answer. G we didn't.
So here 120 and 80. So it is 200. How much you got payback period? What is your payback?
I got 1 year and 8 months.
And what is its solution? Can you please let me know the page number for the solution?
Solution.
Okay, I will listen. Test your understanding well, right?